So as of right now, the jury is still out on who is going to be the president of the United States come January of 2021. And for obvious reasons, the commercial real estate industry has kept a close eye on this race throughout the entire year because of some significant changes proposed by the Democratic Party that could have a major effect on commercial real estate investors if Biden were to take office next year. So since we still don't know what we don't know at this point, and I don't want to just ignore the elephant in the room, in this week's video, what we're going to do is break down what the results of this election might mean for commercial real estate investors and investment professionals, and how this might affect you specifically, regardless of which side you're on. Hey, this is Justin from breakintocre.com, and if you're new here, on this channel we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or do your first or next real estate deal, make sure to subscribe to the channel and hit the notification bell so you don't miss any new videos as soon as they're released. So this year has not disappointed with its share of surprises, and even after Election Day, there is still no clear decision on who's going to take the White House in 2021. A Trump victory would likely mean, for the most part, the continuation of economic policies that many commercial real estate investors and investment firms have found beneficial over the last few years. But if Biden takes the presidency, there are a few big proposed changes for the commercial real estate industry. And in this video, what I want to do is walk through 3 of the biggest potential impacts of the results of this election on the real estate space, what they mean, and how all of these things might affect you as a real estate investor or investment professional going into next year. So first, and potentially the biggest issue that real estate investors have had their eye on most over the past year is the potential elimination or significant restriction of 1031 exchanges in real estate transactions. Earlier this year, Biden proposed eliminating 1031 exchanges during his presidency, which could potentially be a big blow to the real estate industry as a whole. As of right now, 1031 exchanges allow real estate investors to defer capital gains on the sale of investment properties when traded into an asset of equal or greater value, which ends up incentivizing investors to keep their money invested in real estate over the long term. The 1031 exchange system itself is nearly 100 years old and has a major impact on the commercial real estate market, but also the rest of the US economy overall. 1031 exchanges add significant transaction volume to the real estate industry as a whole, and the more transaction volume in the industry, generally the more revenue generated by both state and local governments through things like transfer taxes, and the more fee income generated by brokers, lenders, law firms, and many different other third parties associated with a real estate transaction. There are even companies out there that are solely dedicated to the execution of 1031 exchanges, either as qualified intermediaries that hold funds during a transaction, brokerage firms that focus specifically on 1031 exchanges, or even major real estate investment firms that place 1031 capital, like Inland Investments, a company with almost $8 billion of assets under management as of the end of last year. Standalone triple net property values for things like banks, drugstores, and national fast food chains are also highly dependent on 1031 exchange money because many veteran investors will turn to these properties to park their money in an asset with guaranteed long-term cash flow and extremely low intensity or hands-off management. And even though the effects of getting rid of 1031 exchanges will probably hit these parts of the industry hardest, the elimination of 1031 exchanges would also likely have a pretty widespread impact on the economy as a whole. According to a 2015 study by Ernst & Young, eliminating 1031 exchanges could cut US annual GDP by up to $8 billion and could cause significant ripple effects across the construction, engineering, trucking, and other real estate adjacent industries. Another 2015 study conducted by Syracuse University and University of Florida professors found that property values could drop by up to 20% in most markets and as much as 27% in states with high tax rates if the 1031 exchange rules were to go away. And this would be another big blow for transaction-oriented real estate firms, which have already struggled significantly this year, with US real estate investment volume dropping by over 60% year over year between Q3 2019 and Q3 2020, according to the most recent CBRE US capital markets figures. So 1031 exchanges could potentially be on the chopping block, but what else is on the docket if the power in the White House shifts from Republican to Democrat? Well, the second change that could impact both commercial and residential real estate is the potential removal of the SALT deduction cap. The current state and local tax deduction for personal income tax purposes was capped at $10,000 in the 2017 Tax Cuts and Jobs Act, and since then the Democratic Party has been working to repeal this cap, and Biden has expressed his support for the repeal as well. And if this happens, this is actually some much needed good news for high cost of living states like California and New York at a time where many people are leaving these states in search of a lower cost of living somewhere else. In fact, a recent survey done by Upwork showed that as many as 23 million people may be moving in the near future due to remote work possibilities, and many of those survey respondents cited leaving large, expensive metro areas for smaller, less expensive cities. And if the SALT cap is removed, major metros with high property values, high property taxes, and or high income tax rates might just become a little bit less expensive for residents from an income tax perspective, which could potentially help to keep a few less people from moving out in the coming years and a few more people to come back in. As we talk about a lot on this channel, cost of living, including income taxes, is a significant driver of net migration within the US, and net migration patterns are really some of the leading drivers in real estate demand, so this is definitely something to keep an eye on depending on how the election shakes out. And finally, aside from the SALT cap and 1031 exchanges potentially going away, the third big issue that might be affected by these election results is what happens with federal assistance in 2021 and beyond if necessary. With stimulus money running out and property owners from the restaurant, retail, and multifamily industries really concerned about their futures without additional federal support, a Democratic White House would likely mean a larger stimulus package in the future, which could potentially be good news for residential and retail landlords who rely on individuals and small business owners to continue to pay their rent, and for individual consumers to continue buying from retail stores. The CARES Act, passed earlier this year, provided an additional $600 in unemployment benefits to U.S. residents at the state level, but these funds expired at the end of July, and even with Trump extending this benefit at $300 for an additional 6 weeks, there still isn't a clear solution as far as how people impacted by job losses due to store and business closures are going to receive any sort of additional federal aid heading into the end of the year. And while Biden's plan doesn't currently go into specifics on how much funding will be available, it does say that a bill would boost unemployment benefits, and it also calls for an additional $200 per month of Social Security benefits, both of which could be a big win for landlords with a struggling tenant base right now. So there are some potential changes brewing overall for the real estate industry, but at the end of the day, regardless of which direction the election goes, what does all of this mean for you as a real estate investor or investment professional looking to break into the industry today? Well, the first thing to keep in mind specifically about 1031 exchanges is that this is not the first time that 1031 exchanges have come into question. There have been multiple proposals in the past to do away with this rule, including as recently as in a version of the Tax Cuts and Jobs Act of 2017, and each time this rule has been deemed too valuable to the overall economy, which has helped 1031 exchanges stick around for almost a century at this point. As with every election year, it's important to note that a proposal is just that, a proposal, and there's no guarantee any action is going to be taken on that either now or in the future. Now second, contrary to what might be popular belief, the biggest real estate investment firms in the country were not all primarily Republican supporters heading into the election. Political donations to the Biden campaign from individuals in the real estate industry were over $34 million as of the end of October, while Trump's campaign only received $23 million, according to the Center of Responsive Politics. So while there might be tax increases for corporations or high income earners in the pipeline in a Democratic win scenario, at a high level, real estate investors and investment firms don't necessarily see a Democratic White House as a bad thing, and many firms and individuals in this space were actually pushing for a Democratic victory heading into the election. And finally, it's important to note here that historically, the winner of a presidential election hasn't had a significant impact on real estate values over the last 40 years. According to a Cushman & Wakefield report citing NCREIF data, real estate returns have been strong under both administrations, and CRE returns have averaged somewhere between about 7% and 10% annually under both parties. CBRE's election analysis also painted a similar picture, citing that cyclical factors have much more of an influence on commercial real estate returns rather than who ends up winning a presidential election. So overall, we just don't know what's going to actually be followed through with and what is not, regardless of which party wins. But these are three things commercial real estate investors should have their eyes on right now, and how the election results might impact where the real estate industry goes in the next 12 to 24 months. So I hope this video was helpful. If you like this and want to see more videos on current events and how those are affecting the real estate market, make sure to hit the like button and subscribe to the channel so you don't miss any new uploads as soon as they're released, and I'll see you in the next video.